Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to help you make some money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. 1 year ago today, we bought the stock of Home Depot for the Charitable Trust. We were looking for a rate cut at the September Fed meeting. Historically, a terrific boost to the stock of this tremendous chain. Oh, we got that rate cut, but it didn't do what it was supposed to. Longer-term Treasury yields spiked in response, sending mortgage rates higher and starting a huge descent for the stock of Home Depot. But did we sell? No. We did the opposite, and we told you to do so, too. We bought more and more and told club members, at last, this is your chance to get big in the stock of Home Depot, which you don't usually get to do. Why did we do that? Because of days like today, when the stock shot up $6 and change, and the franchise value shines, part of a general market advance where the Dow gained 350 points, S&P advanced 0.83%, and the Nasdaq jumped 0.98%. Lots of pundits make fun of people like me who urge you to buy the dips. But not all stocks and not all dips are created equally. Some are a heck of a lot better than others. Home Depot is one of the better ones. Sure, you had to endure some real pain over the last year, and I am sure some club members thought we were nuts with our relentless advocacy of the chain, buying it right into some ferocious selling. But now we're starting to see signs that the Fed has no choice but to start cutting again, and it is time to reap the gains. Tomorrow we get the Labor Department's non-farm labor report and all that free data that we just saw today, job openings, ADP reports, exec surveys. They indicate that even though we have some tariff-related inflation pressure, could be one time only, the job market's weak enough that we're going to get that rate cut, and it will be meaningful, and that's exactly the moment when I think Home Depot is really going to spike. And you know what? When you buy the stock of a tremendous franchise like this company, you don't have to be right about all the details immediately. You just need conviction that one day you'll be real right. One day. That's why I want to spend some time tonight on what it means to buy the stock of a great franchise into weakness, not some software as a service company or a red-hot semiconductor equipment stock or the life sciences business, all of which are endless ragers until they aren't, but of a really very good growth retailer that we all know with a terrific reputation that can take a licking and keep on ticking. First, let me just say that I do like the semis and the software companies. I'm fine with healthcare. I like growth wherever I can find it. You never go wrong with tech growth as long as it's measured and profitable. But often it isn't. Growth does come, though, in many forms, and one of them is in retail. I have my stable retailers that I know are well-managed, companies that can deliver in any environment. Not immediately, though. Home Depot stock traded down to the 330s at its post-Liberation Day lows after we bought it a year ago. Now, we did buy pretty much the whole way down. We bought it for the trust, giving us a great cost basis. Now we're up nicely with the stock back to $411 and change, even as nothing much has happened yet. In fact, Home Depot missed the last quarter, and the stock opened down big. Again, another alert from us to buy, only to rebound when management told us on the conference call that the quarter started slowly, but then got better and better. That's called a good cadence. How did I know that the dip buying, so castigated by so many wise talking heads I see on TV, would work? Because the stock of Home Depot met a six-part criteria I have always used when I want to buy a quality growth retailer into weakness. Here are the six. First, do you personally shop there? I don't ever want you to buy a retailer that you don't shop in. That'd be ridiculous. I'm a gardener. That means axiomatically I go to Home Depot. If I thought, by the way, my Home Depot or Home Depots, I have more than one, were dirty or didn't have good customer service or didn't take care of their plant inventory, you got to spray them all the time, I couldn't justify owning the stock. If I bought the stock and then it went down, you know what would happen? I'd just give up and I'd kick it out. Oh, buy high, sell low. Now, there is an ill-advised strategy. There's a reason, by the way, that the trust also owns Costco. We shop there constantly. We have 4 different Costcos where I live, and I always visit one if I see one. I do that because it's a core position, but also because my wife and I just can't stay away from the place. I've never been worried. Richard Galanti, the former CFO, put the fear of God into all of Costco's suppliers to ensure they kept prices low. The Costco card's one of the best bargains on earth. But if I didn't walk the stores, I wouldn't know to buy more stock. But I don't go to American Eagle Outfitters, today's rager. Don't ask me about that woman who knows about her jeans. What the heck's that? That seems like a real one-off one of me. I always used to shop at Target, but now I only shop there when I'm in San Francisco because I think it costs too much. But Home Depot, low prices, good service, fabulous. Second, how's the balance sheet? If you listen to Tony Spring last night, the CEO is turning Macy's around. He seemed most proud of how he'd been able to improve the balance sheet at what was a very cyclical retailer. And, when you're in a cyclical business like retailing, you can't afford to have a weak balance sheet. Home Depot, in 2007, we had the worst housing crisis this nation had seen since the Great Depression. Every hedge fund manager and his second or third cousin shorted anything housing related, including Home Depot. Oh, they all made out like bandits betting against the Lennar and the D.R. Horton. Oh, but those who bet against Home Depot, sorry. Why? Amazing balance sheet. That's why. It's a cash flow machine. It came out so on top that people who bought it and stuck with it made fortunes. I remember that. Third, you need a management team that refuses to sit still and wait. Home Depot recognized that the housing industry wasn't going anywhere in the last few years thanks to a lack of inventory and higher interest rates. So it decided to play into its own strengths and acquire businesses that work well with professional contractors. Businesses that excelled in roofing, pools, ceilings, ones that could deliver to job sites, ones that could work even if home building slowed down, which it did. Fourth, you need a management that wants lower interest rates but doesn't need them. I don't like any stock that needs the Fed to be helpful. That's all I have to do is keep watching the Fed. Those are for suckers. You can't just sit there and sweat about what the Fed's going to do. You want to be able to make money even when the Fed's not inclined to bless us with lower rates. Then you can really clean up when they finally do start cutting. Fifth, you need what we call scale. You have to be so powerful and have such a large footprint that you can manhandle your suppliers. They all need their shelf space, and not vice versa. A company like Home Depot has leverage over suppliers. So if something happens like the tariffs, they can tell anyone who's really raising prices beyond reason, cut it out, or you're out of the store. Scale is might making right. Sixth and finally, is it good enough that you don't have to trade it? Home Depot has a solid 2.23% dividend yield. You can own it and let that dividend compound over time. You have no need to flit in and out of the stock. Trading in and out is another rarely rewarding strategy because it's almost impossible to time it right. When you buy quality, you can let it compound for the rest of your life. And that's how the big money is made. Oh, and the bottom line, when the Fed does start cutting, your slow-growing retailer stock gets turbocharged as all the so-called smart money then comes flying in. If you bought the stock on the dip like we suggested, you now have the privilege to call those people chasing the stock of Home Depot by their real names, dumb money. And I only put it that politely because there's some words that you can't say on basic cable or even streaming. Let's go to Jonathan in New York. Jonathan.
What's going on, Jim Cramer? What's going on, buddy?
I don't know. I'm liking the tape. We got this one right. I told the club members, nice call. Let's go to work.
Wonderful. Good to hear. Listen, buddy, I'm calling about this trade desk. I owned it before the pandemic, and I sold it, and I've always wanted to get back into it, and now it's at that April price. But,
look, it's down 55%. I like Chef, but they've got Amazon as a competitor. And, Amazon is one of my absolute favorite companies, and I don't want to go against Amazon. Can you make some money? Yeah, but there are other ways to make money that are easier and better. How about we go to VJ in Massachusetts? VJ.
Hi, Jim. This is Vijay Kodia from Boston. How are you?
I am doing well. How about you, sir?
Good. I have a question on Walmart stock.
Yes, sir.
Considering rising inflation on one hand and potential tariffs on consumer staples on other, how do you foresee two factors impacting Walmart stock in long run?
Okay, I'm so glad you asked me this because people have Walmart wrong. They are a very forthcoming company. They say, listen, we're going to have some problems with Walmart. They're very honest. They're terrific. And what they've done is it's actually ended up scaring people out of their stock. It does have a high price earnings multiple. I do prefer Costco. I do hope Costco has a just okay month so you can buy that cheaper tomorrow. But Walmart's fine. It's a fine stock. All right, listen to me. Owning retail growth stocks like Home Depot will help you get through thick and thin. And when the Fed does start cutting rates, be ready to make some turbocharged gains. Oh, man, money tonight. Big Blue is delivering big AI data for fantasy football. I'm learning more about how the company produced over 36 billion insights to help fans in their drafts. Then Palo Alto Network CEO is out with a bold prediction when it comes to the future of browsers. I'm hearing more about his stance with the man himself. And Hinge Health has been one of the year's strongest IPOs after reporting a phenomenal first quarter. I'm checking in with the digital physical therapy player to see if the momentum could continue. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.